Hi, so you're welcome back to my YouTube channel. So let's look at how Warren Buffett, the three simple rules that guides Warren Buffett's investment. Okay, so this principle is also applicable for those who swing trade or day trade. Okay, so let's start with the first one that says never lose money. That is his first principle. He believes that you shouldn't lose money in the market. So what does this mean? This means that you should learn proper risk management. You know, in my last video, I talked about George Soros principles as well. You will see this guy also talking about, George Soros also talking about risk management in his statement. If you watch one of the documentary and interviews of these guys, you will see all these things that I'm talking about. They mentioned them, they talked about them. So the first principle of Warren Buffett is never lose money. So what he's saying is, whenever you are trading, you want to ensure that you protect your capital, either by setting stop loss. In the case of swing trader, you set stop loss, or you don't over risk. Okay, you don't risk too much of your capital. It's either you risk the standard amount you should risk is either 1% or 2% of your total capital. Okay, so that is the first rule. So let's go to the second rule. The second rule says stay within your circle of competence. Okay, these are expressions made by Warren Buffett, not my own. Stay within your circle of competence. So what is Warren Buffett trying to say here? What Warren Buffett is trying to say is that if you are the type of person that trade forex, okay, and you know forex, you know your currency pairs well, then you have no reason. Don't, because of the fact that they say, oh, what's it called, crypto is going bullish, people are buying crypto. That doesn't mean you should, because of that noise, and join them in crypto. Since you don't know anything about crypto, like since you are not a good trader, you've not been trading crypto, so then there is no reason for you to join them. Okay, try to stick to that asset that you trade, that you understand very well. Stick to it. Take for example, like my humble self now. Ever since I leave currency pairs and I've started taking stocks, trading stocks, I don't find it. I don't find it interesting trading currency pairs again, because now I understand the stock market. I understand how it works, and that gives me more edge in the market. So you want to stick to that thing that you know particularly. In fact, I used to trade cryptocurrency before, but at some point I just feel like trading all these things together is just making things complicated for me. So I just need to streamline everything and stick to the ones that I know very well and that is suitable for me. So you want to understand your niche and stick to it. Is it crypto? Is it forex, currency pairs? Is it stock market? And even if you are trading any of this market, you want to make sure that the assets you are trading is not too much. Let's say you are trading currency pairs. Don't trade every currency pairs. At least 5 currency pairs is okay. The major ones is okay. If you are trading stocks, the major stocks stocks is okay. And if you are into investment, just invest based on your fundamentals, that which I've explained in this video. So make sure that you stick to your circle, you stick to the ones that you know. Okay, so let's go to the third one. So talking about the third principle, he said be fearful when others are greedy, and greedy when others are fearful. What does this mean? In this case, I will have to take you to my computer screen and show you something. So basically what he's saying is that when the market is going bullish and the price is going high, okay, people continue to buy, people continue to hold position. Okay, so when most people are supposed to have closed their position, they will still keep holding that position. That is being greedy. Okay, so what he's saying is that during this period, the market has gone high and it has overbought. Market is likely to sell. That is when you want to sell the market. When market has been overbought and people are still being greedy, are still holding position, that is when you want to sell. And that is why sometimes you see some people holding position, all of a sudden just drop. It's because of people like Warren Buffett who short those markets at that particular period of time. Okay, then talking about fearful, you know, when market started crashing, Warren Buffett see it as an opportunity to buy. Okay, and market doesn't crash. It's either there is fear or certainty. Like now, there is tariff of a thing. Now market has been crashing because of that fear. People like Warren Buffett will start buying those deep. Okay, so I will take you to my computer screen and show you chart analysis on this particular principle. Okay, so let's go to my computer screen now. All right, so look at my screen. I want to show you something quickly. So let's go to this index, S&P 500. Now, here's the thing. If you look at the market, has actually been crashing from here. Okay, down to this particular point. You see, now the cause of this crash is because of the fear of tariff, what it could actually cause to the economy, the world economy, US economy, and everything. That is the reason why this thing has been crashing. Now, what Warren Buffett is trying to say is that because people are scared and they are selling their stocks, and you see selling pressure coming in, that is when you want to actually take buy position. However, what I will advise you is that when you are trying to follow this principle, you also want to pay attention to whatever that is going on at that particular time and see if it is actually suitable for you to buy or not. Okay. So that is one thing that is what this man Warren Buffett is trying to say. I believe this video is helpful. Don't forget to like and subscribe. See you in my next video.